The African Development Bank says Africa needs to spend $360 billion in order to see significant infrastructural development by 2040, making large investments in infrastructure projects among the most pressing priorities for African governments. As a result, competition for funds is now global as the continent taps into international bond markets. In 2014, there were $9 billion worth of Eurobond issues on the continent, but new issuances from the region, excluding South Africa, dropped to $1.5 billion in the first 6 months of 2015, with only Côte d'Ivoire and Gabon coming to the market, an indication of growing external debt servicing troubles. In recent months, there has been a change in sentiment around Africa as commodity prices continue to fall and local currencies fade. But the 16 countries that have issued Eurobonds on the continent, typically denominated in dollars, may be among the most vulnerable. Investors are concerned that slowing growth in China will depress prices of commodities. Falling local currencies are adding to the pressure by making it more expensive for countries to repay external bonds. Some experts say that some African countries may have been borrowing rather quickly. Ghana, who is planning its third Eurobond sale of $1.5 billion this month, is likely to find it very difficult to re-enter the Eurobond market. The country, whose main exports are gold and oil, is grappling with a shaky economy and a large budget deficit. Its public debt has shot above 60% of GDP, and the cedi has slipped 14% against the dollar this year. Zambia's central bank says that the kwacha was under immense pressure because of the falling price of copper, from which the southern African nation derives 70% of export earnings. Zambian mines have also been hit by a power crunch, with some mines having to close their doors this year. Standard & Poor's reduced its credit rating on Zambia from B+ to B in July. However, Africa's debt levels are still below 50%, while the woes of countries like Ghana and Zambia are likely to make investors command larger premiums for future Eurobond offerings. Demand is likely to remain strong for the more solid economic growth stories, such as Kenya and Nigeria. Potential Eurobond debutants, like Tanzania, are likely to attract demand from frontier markets and Africa-focused investors seeking to diversify their portfolio risk. Ucheo Koronkwo, CCTV.
Right, then let's see what investors are doing, voting in their wallets as it were. Jade Barker is live in New York with more data on trading in sub-Saharan Eurobonds. Jade, we've seen yields on debt from issuers like Zambia and Ghana go past 10% so far this year. Have we seen a flight to safety in tandem with that out of sovereign African debt?
Well, we may be at a bit of a turning point, as some investors I've been speaking to say they do have some reasons to be wary. In terms of Zambia, it's a commodity story, as we just heard in that report. It's Africa's second largest copper producer, and the metal price is not doing that great. There's also those structural problems in the country with those power supply issues. So investors may look at this and be a bit worried and think, well, if the government can't even get electricity to those key places like their own mines, how is it going to repay its debt? Ghana is in even a more precarious position. They also have chronic power problems, a weak currency and high inflation. Also, the benefits from the oil sector have not been as speedy as some might have hoped. And of course, you've got to bring China into the factor here. No country stands alone in the global market. China is a huge consumer of copper and other resources, so their economic slowdown also affects these sub-Saharan African countries. There's concerns starting to creep in about African governments slipping back into bad habits of borrowing beyond their means. So yes, we're starting to maybe see a move away, or so perhaps increasing concerns from investors over African debt.
Indeed, but isn't there an argument to be made here for risk differentiation? I mean, we're looking at commodity-dependent economies like Ghana and Zambia. Obviously, they're facing a far bigger yield squeeze, but what about more diversified issuers like Kenya, for example?
Well, I think there is most definitely more confidence in those more diversified issuers, as you said, like Kenya. And the advantage of Kenya is that it's a more service-based economy. It has a healthy tourism industry, even though that's taken a bit of a hit in recent times with terrorist attacks by groups like Boko Haram, but the government has put security as a priority there, and tourists are beginning to go back to the country. It's also a huge expat hub for the big business community. A recent survey even revealed that there's more conference tourism. That's businesses going to Kenya, holding conferences there, and then perhaps using that as a base to expand their businesses in other parts of the African continent. And that's bigger in Kenya than it is in South Africa. So while Kenya's economy is struggling and they also have their problems, there's a level of confidence in the government there that we don't see in some other African countries, which makes it less of a risk to investors and therefore more attractive.
Indeed, we'll have to leave it there for the time being. Jade Barker live in New York, of course, looking at Eurobonds and their performance and risk differentiation, especially for investors in North America and in Europe.